Hello, everyone. Tony Mello, Mello Properties team. Hope you're all doing well. Cell phone 508-369-9755. 508-369-9755. Going over some financial terms, real estate financial terms. Just kind of brushing up on a few things, and I'm going through some of these definitions of different things. Saw some stuff that may be of interest to you guys, things that you can use. Obviously, I'm not going to read all of this, but I'm going to just pick a few things and then run with it. Um, Commitment letter, a notification from a lender indicating a loan has been approved. The commitment letter will have an expiration date. Commitment letter is one of those critical dates that we have on both the offer and the purchases and sales. Should have it in there. And it is basically just like what it said. It's a letter from the lender, and they all give, except for one that I can think of, that commitment letter. Most times actually these days, it's a conditional commitment letter. So they're saying, yes, as far as we've seen so far, we are going to commit. We do think that this closing will happen, and we will be able to give you that money, but you have to be able to provide us this. That's part of the whole clear to close thing, where at the end, and they're continuously running over these details and clearing things. But at some point in time, they're going to run through that list and make sure that they've cleared all those conditions, the underwriter. Once those conditions are cleared, then you get a clear to close, and the lawyer can go ahead and do their thing. So that's commitment letter. See if I can do, this is 1 minute, it's almost 2 minutes. See if I can find another topic in here. Debt service, periodic payments made on a loan, principal and interest. So that's the debt service, the mortgage, what you're paying the bank. Now you notice there they said principal and interest. Principal comes off the top of the loan payment. Interest is money that you're giving them for the privilege of borrowing their money. There is a thing called PITI. It was in one of these here. PITI, principal, interest, taxes, and insurance. So obviously principal and interest, I just explained what that is. Taxes and insurance. In most cases, you're going to have what's called an escrow account. The bank is going to take a portion of the money from your mortgage, from the payment that you give them, put that aside, an escrow account, and use that money to pay the taxes and the interest. Not always when they give you some of these numbers will they give you the PITI. And there's a good reason for that, because until you found a house, they don't know what the TI is, the taxes and the insurance. The bigger the house, the more the insurance. The bigger the house, the more the taxes. So they'll give you the principal and interest that they can figure out on the front end. They won't give you the TI, the taxes and insurance, until you found a property. So that gives you a little bit more of what that monthly mortgage payment is going to be. Everyone is accustomed to saying mortgage, 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 and yes, and we basically use that as the de facto way of talking. But a key distinction, at least from the real estate end, a mortgage is not debt of payment. A note is debt of payment. Mortgage is you pledging your property in case you foreclose and don't pay that note. The mortgage is collateral. It's like a security deposit for the money that they've loaned you. So if you don't pay your bills, the mortgage gives them the right to go after your property to foreclose. And that's that. 3 minutes, almost 4 minutes. Let's see what else we have here. Discount points. Maybe something you come across. Discount points. Sometimes loans that are sold to investors might be lower than the investor mandates. Investor wants to make more money. Thus, the lender charges a discount point to the borrower to make the loan more attractive for themselves, and profitable to the investor, tax deductible. So the discount points are tax deductible. What they're basically doing is they're charging you, and even FHA is doing this, they are charging you a certain amount of money up front, percentage of the loan purchase price, for the benefit of having a particular interest rate. For example, FHA, let's go with that. Used to be that FHA would do loans at a credit score of 630. Because of 2020, 2021, this COVID crisis that we're going through, some of the debt forgiveness, rent forgiveness, mortgage forgiveness, all that stuff that's going on, FHA changed that credit score of 630, the requirement of 630, to 680. That doesn't mean that they won't do 630. They'll do 630, but they're going to charge you points. It's basically a fee that they're going to charge on the front end for the benefit of giving you that FHA loan at the 3.5% down. So I'm not a loan officer, so there's a lot of stuff in here that may be different for particular banks, may be different for particular lenders. They all have their own little style of doing things. There are definite rules for different, loan programs, but they all have different access to different loan programs too. So that's the discount rate. It's basically prepaid interest. You're paying interest ahead of time for the benefit of getting something, an interest rate that is lower out on the front end. So for something like that, in my mind, the way I would start thinking about it is, how much am I paying on the front end? How much would I not be paying if I was paying it in interest? How far out in time does that take me? At what point in time does my money that I'm paying on the front end equal out? And from that point forward is your break-even point, and now you're starting to make money from that point forward. If you calculate it out, and I've never done this actually, but if you calculate it out and that break-even point is 15, 20, 30 years from now, and you start making money on your money, after that point in time, then in my way of thinking, it's not worth paying those points up front. Just take the higher interest rates if you can't find anything better, and continue with that. So the idea of paying a prepaid interest up front for a particular interest rate is one that it just depends on the math, as far as, all right, here's situation A, here's situation B. What is the total benefit to me for me to do this kind of thing? Loan officers should be able to help you with that. I'm not sure if they typically do that kind of stuff. But it's something that can be calculated more or less. All right, I'm going to leave it at that. I'm going to do a lot of more videos. We're at 8 minutes. I'm going to keep these really small and kind of hit just certain topics on here. Tony Mello, Mello Properties Team, 508-369-9755. Have a great night.